Hello there and welcome to our webinar on charities and trading subsidiaries. My name is Tracey Bird and I run the SCVO Information Service, and thanks to you all for joining us today. Just to note, this webinar is being recorded and will be available later on the SCVO website. Also, we'll email slides and any additional resources to you all after the webinar. So for a charity, trading can be a valuable source of income, but charity law and tax rules can combine to make charity trading potentially difficult area. So I'm really glad that we've got with us today partners from our Pro Bono service to help look at the pros and cons and potential pitfalls. Our financial experts, Scott Craig and Kirsty Murray, are from Azets, who provide free VAT and tax advice service to SCVO members with an income of less than £500,000. And our legal experts, Leanne Lodge and Chris Smith, are from Gillespie Macandrew, and they provide our members with free legal advice on all manner of topics, from governance to property to employment law. If you'd like more information on any of this, then do go to our website or drop me an email. I encourage you to post your questions in the Q&A facility as we go, particularly as we have access to a lot of expertise here today. And now I'll hand over to Scott to begin the presentation. Thanks, Scott.
Good afternoon, everyone. And I can have a call on Leanne perhaps as well to help me out here. This is good. Thank you, Leanne. So we've got the slides. So hello, everyone. Good afternoon. As Tracey said, you've got a double header today. You've got accountants and legal advice all in the one captive room. Free as well, pro bono stuff. So the double bubble benefit here, definitely. As you can see, I'm Scott Craig. I'm a tax partner at Azets Accountants. And from the accountancy side, today's presentation has been made by myself and Kirsty Murray, who you can see there. Kirsty's a corporate tax specialist. I'm a VAT specialist. And we work together to provide a complete tax advice service to all of our clients. We do specialise in charities, not-for-profit bodies, third sector bodies. And we're also part of the Azets national charity group. So we also interact with colleagues, not just around Scotland, clients just around Scotland, but also in the rest of the UK as well. So we can often bring a slightly different flavour to the tax discussion that we're having. Leanne, can I get you to introduce yourself and Chris?
You can indeed, and hopefully the slide has moved on. So for those of you who don't know me, I'm Leanne Lodge and I head up the charity team with Gillespie Macandrew. I'm one of the partners there. And we've also got Chris Smith, who heads up the corporate team. While Chris is on the corporate side, both of us do actually sit on boards of charities, and we think it's quite important as a team to understand both sides of it. It's very well and good for us to give you the legal expertise, but actually knowing how it works on the other side is really quite important to us. And as a charity team, we encourage all of our colleagues to do that. Now we've got quite a lot to cover, so without further ado, I'll pass back to Scott, who's going to start the presentation. Thank you very much.
Yes, and as said, we've kind of come together to provide an overview of subsidiary companies for charities. We're frequently asked, and I think Leanne and Chris will say the same thing, is do I really need a subsidiary or do I need a subsidiary? The answer really depends on a few factors. There are practical issues, there are legal issues, and there are tax issues. And probably the best answer is a mix of all of those. And it's probably unique to each organisation. So just because another charity has a subsidiary company doesn't necessarily mean you should have one. However, there may be a lot of really good reasons why you should put one in place. So today we're going to give you, I guess, an explanation of the various factors, the legal and the tax issues that come together, and will hopefully kind of give you a bit more direction on whether you need that subsidiary company, and if you do, what you need to do about it. And if you've already got one, is it still fit for purpose? We're going to cover today, why you should use a subsidiary. We're going to cover the legal structure of subsidiary companies and the different kind of, I guess, kind of issues you need to think about when it comes to the legalities. We're going to talk about tax, both VAT and corporation tax. We're going to talk about the interaction between charity, subsidiary company, and what happens if you need to cease or wind up a subsidiary. We'll touch on that briefly. And Leanne's going to cover near the end some OSCR concerns. And then we're going to finish by opening up the floor to allowing you to ask any questions you have. specific, theoretical, whatever you want to ask, that's the time to do it. That said, if there's anything on the way through that you want to flag up or you're not quite sure of, please just ask us on the way through. So if I can move on to the next slide. The first question, I guess, is why do charities really use subsidiary companies? And well, it can be one of many reasons, but trying to condense it, as I have here, it can be to protect charitable status of an organisation. It may be that you've got a specific set of purpose and activities that you want to keep, and that's therefore you need a subsidiary company if you're going to be extending beyond that, or if you decide that you want to widen the geographic spread of where you're undertaking your activities. There's also the fairly blunt one that people often want to reduce the amount of corporation tax that a charity will pay. So Kirsty will explain that charities can and do pay corporation tax, but there are ways of minimising that. They're on the VAT side. I'll touch off, there's no show without punch, so I will touch on the VAT side of things and explain why VAT can benefit or subsidiaries can benefit the VAT position. There are risks, so this is not financial, just there can be financial, but there can be other risks to either the trustees or the organisation itself, the charity itself. So again, subsidiaries might be required there. And there's the last one, which I've mentioned before, just because other people have got one and we think it's a good thing to do. I would like to think that people are a bit more sophisticated these days. Maybe that was something that was done on a knee-jerk reaction a while ago, but not so much anymore. And hopefully at the end of this presentation, you'll have more of a feel for what you really need to do and what you want to do. So I'll pause there. If I can hand over to Chris to talk about the legal structure.
Hello. So you've decided that you're going to have a charity trading subsidiary for the purposes of my talk. You've spoken to Azets and had advice from them, and it sounds like a good idea. What do we actually mean when we talk about a charity trading subsidiary? What actually is it? Well, in one view, it is nothing at all special, because by far the most common legal structure for a charity trading subsidiary is a company limited by shares. And a company limited by shares is the sort of company that is used by the vast majority of commercial trading businesses in the UK and is widely recognised throughout the world as well. So there's nothing particularly special or unique about the legal structure of a charity trading subsidiary. It's a very familiar sort of thing. And in fact, it's a less unusual thing than the structure that your charity itself probably has. The reasons why a company limited by shares is used is principally because it isolates risk. That is the whole point of a limited company. That is what the limited means in limited company. When you set up the limited company, the company itself becomes a separate person in law. So separate from its shareholders, separate from its directors, and separate from the parent charity in this case. It signs its own contracts, it can own its own property, and crucially, if things go wrong and the business, the charity trading subsidiary, fails, owing money that it can't pay, it is the company that owes the money to the creditors and can't pay it. And the creditors cannot come after the shareholders, in our case, the charity parent company, for the money. So when we talk about one of the reasons being to isolate risk, that's what we mean. The parent charity, just like any shareholder setting up a company, only stands to lose whatever money they've agreed to put into it, whether that's by way of investing for shares or lending the company money. And so that is the extent of the parent charity's risk here. If things go bad, they don't lose everything. The charity's own assets are not at risk. The charity will probably have to risk some money by funding the trading subsidiary to get started, to carry on its business. And one of the advantages of a company limited by shares is they can do that by subscribing for shares in the company and receiving dividends in return. But there are other ways too, which have different financial consequences. For example, many parent charities choose to lend money to the subsidiary company to get it off the ground. You do need to be a bit careful about how much funding you put into the trading subsidiary and how often. It must always be for the parent charity's main purposes, and we'll go on to talk about that in this session later. And on the next slide, thank you, Leanne, for taking the hint there. A bit more on what we actually mean by a company limited by shares. How is it brought into being? I said when you create it, it becomes a legal person in its own right. How does that magic happen? It's incorporated by a process of registration at Companies House, which is the UK company registry. It will be given a constitution, which in the case of a company limited by shares is known as its Articles of Association. That is actually less important than it is in the normal company situation, and less important than a charity's own constitution is. And the two reasons for that is, firstly, that a company's articles are principally about regulating relations amongst the shareholders of the company. And in the case of a charity trading subsidiary, it will almost always have only one shareholder, namely the parent charity. And so there are no relations amongst different shareholders to worry about. And also, you don't have the considerations that you do with your own parent charity constitution, because to be a charity, your parent constitution must meet certain rules required for charitable status. It must have an asset lock and things like that. None of that applies to the charity trading subsidiary because it is not a charity, and therefore it will have powers to do anything and everything, and is not restricted by charity rules. And a company has basically a two-tier structure. The shareholders I've already mentioned, they own and ultimately control the company. And the means by which the shareholders of a company control it is by having the power to appoint and remove the board of directors who manage the company day to day. And I'll go on to say a bit more about those on the next slide. Not the next slide. The company's name is very important. Companies are registered at Companies House with a name which is on their certificate of incorporation and is the name they must always use to continue to benefit from the protection of limited liability. It will usually include the parent charity name, but it should be sufficiently different that you can distinguish, because there may be people who work for both the charity and the trading subsidiary, and it must be always clear who they're representing. So you should be careful to use the trading subsidiary's name for all purposes. And we'll go on to talk a bit more about relations between the parent charity and the trading subsidiary, and how those are regulated, and the extent to which the charity allows the trading subsidiary to use its own assets, and the charity's name is one of those assets. So you will need to consider the basis on which the company uses the name, and indeed will the company pay the charity for the right to use that name and perhaps also its logos. And almost certainly, unlike a charity, the company's name will have limited at the end to signal to people dealing with it that they are dealing with a limited liability entity. And just further regarding the company's constitution, it is not a charity constitution, so will not have these familiar charity requirements in it. And for example, the directors may be paid. And I think I've already talked about that, Leanne, so on to the next slide. I said that it's typical for a charity trading subsidiary to have only one shareholder, namely the charity itself. It's not impossible that it could be done differently. There may be a joint venture between two or more charities, in which case the trading subsidiary might have more than one charity parent. It may be that the funding for the trading subsidiary is going to come not just from the parent charity itself, but from others, in which case there might be other investors in the subsidiary. You would need to take advice, and then back to Azets again for this one here, because some of the tax reliefs that Azets are going to go on to talk about will not apply if the parent is not the only shareholder of the company, but there are circumstances where it can happen. And lastly, you need to think carefully about who will be the directors on the board of the trading subsidiary who will manage the company day to day. The parent charity can be relatively comfortable about that because as sole shareholder, they will have the right to appoint and remove the board of directors, but they will need to appoint an effective board of directors, bearing in mind that the parent charity will have commercial relationships almost certainly with the trading subsidiary. For example, if the trading subsidiary operates out of premises let to it by the parent charity, there will be a lease or a license agreement of some sort. And if the trading subsidiary needs to take decisions about that lease, then any parent charity trustees who are on the board of the trading subsidiary will have a conflict of interest because they must put the interests of the parent charity first because they're trustees of that charity. And therefore, they cannot put the interests of the trading company, which are separate in law. They cannot consider those properly because they're conflicted. And so you should make sure that on the board of directors, you have a sufficient number of non-charity trustee directors to form a quorum so that they can consider questions like that when the charity trustee directors are conflicted. And I touched on tax a couple of times there. I'm not the expert on tax. That is Kirsty. So I'm going to hand over to her now to talk you through that.
Great, thank you. So yeah, before you go to Chris to actually set up a trading subsidiary, you need to decide whether you actually need one. So Scott mentioned that a few reasons for setting up a subsidiary, but tax does tend to be the normal driver. So charities don't have a blanket exemption from tax. I often hear people say, oh, we're a charity, we don't pay tax. So that's not entirely true. But what we do have is there is a number of exemptions. And if a charity receives a certain type of income that follows into the exemptions, then it will be exempt from tax. When I'm talking about tax, I'm meaning either corporation tax or income tax, and that depends on how you're set up as a charitable entity. If you're a charitable company, it would be corporation tax, whereas if you were a trust, it would be income tax. So charities are exempt from tax if their income falls into these categories that we've got listed here. So things like bank interest, if you're actually lucky enough to receive any in the current situation, if you get any gift aid or donations, so that could be donations from individuals, donations from companies, or any gift aid you reclaim from HMRC, that would all be exempt from tax. Likewise, if you get any dividends or any type of investment income or grants, that should always also be exempt. Now, land is a little bit more complicated, but if you receive income from land that is pure rent, then that should be exempt. So let's say you've got an office and you're not using half of it and you rent it out. That's pure rent and that should be exempt from tax. The problem arises where you start to provide somebody with extra services. And that's less than just pure rent. It's maybe more like conference facilities, and that could become taxable. So if you had a spare room and you let people use your IT equipment, and then you started providing a member of staff, and then you provided tea and coffee and a lunch, then that's more than just land, and you'd have to be careful because that could be potentially taxable. So next we've got the sale of donated goods, that would be exempt. So this is like high street charity shops selling secondhand clothes and books. That would all be exempt, but the new things that they sell, so a lot of these charity shops will sell gifts that are not donated, then they would be taxable. Next, we've got fundraising events. So these are events that are clearly organised and promoted to raise money for the charity. And all of these should be exempt as long as you don't have more than 15 of the same type of event in the same place in the year. And it's quite amusing reading HMRC's list of examples of fundraising events. They mention things like barn dancers and jumble sales. So as long as you don't have more than 15 barn dancers in the same place in the year, then all the income from that fundraising event should be exempt. And that will include things that maybe would normally be taxable. So say sale of Christmas cards would normally be taxable, but if you're selling it as part of the fundraising event, then that should be exempt too. And then the final one is capital gains. So if the charity has a property, a bit of land, and it sells it, there should be no tax to pay on that. And these exemptions apply as long as the income from them is applied for charitable purposes. And also the entity should be recognised with HMRC as a charity. So as a charity, if you haven't registered with HMRC and are not recognised as a charity, then technically you haven't got these exemptions. So if you are in that situation, I would suggest you go online and register. It's really quite a simple process. So if the charity does have some tax to pay, it would complete a charity tax return and submit that to HMRC. So it's also possible for the charity to have some trading income, and this also be exempt from tax. And the first type of trading income that you can have, which is exempt, is the primary purpose trading income. And this is income from activities that are earned in carrying out your primary purpose objectives as set out in your sort of governing documents. So an example would be, say, an art gallery. It might have free exhibitions, but it might also have some ticketed exhibitions. And all the income from the ticketed exhibitions would be exempt from tax because it's part of your primary purpose. Likewise, if you've got a theatre and it's charging tickets, that's all exempt income because it's meeting your primary purpose objectives. And then we have what they call ancillary trading, and this is things that kind of go with the primary purpose. And I think these are things that people kind of expect as part of the primary purpose when they visit things. So for example, if you go to the theatre, you normally expect there to be a bar, or if you go to an art gallery, you kind of expect there to be a cafe or a shop, or maybe that's just me. So if you have a theatre bar that is open just to the people attending the theatre, then all the income will be exempt. As soon as you open that theatre bar up to the general public, that income becomes taxable because you're effectively just competing with another bar down the road who doesn't have any tax exemptions. Likewise, if you've got a shop in an art gallery, if it's selling replica prints of the art, then that's all exempt. But a lot of these shops will sell a lot more than that. They will sell mugs and tea towels and children's gifts, and that all the income from those sales will be taxable. Next, if we've got a trade that's mainly carried out by the charity's beneficiaries. So, for example, let's say you've got a charity which is helping ex-service personnel to try to get rehabilitated, and they run a cafe. If the cafe is mainly run by them, then all the income from that would be exempt. And then finally, if you've gone through all the other exemptions and you've still got something that's potentially taxable, then what you could look at is the small scale trading exemption. And this is based on the charity's annual income. So in the table below that you can see, if the charity has gross annual income of over 320,000, then it can receive up to £80,000 of income, trading income, and it not be taxable. And so this is to cover anything that isn't falling in any of the other categories. There's also a reasonable expectation test. So if you'd budgeted that you wouldn't go over this £80,000 and in 1 year you just happen to, then you should still be able to claim exemption from that year. So once you've been through all these exemptions, if you find that you still have taxable income, also then you've got two options. You either work out what the profit is on that trading activity and you pay the tax by completing a charity tax return, or you could look to set up a trading subsidiary. But before you do actually go and set up a trading subsidiary, I would really urge you to work out what the tax would be if you kept that activity in the charity, and then consider the cost of running a trading subsidiary. Because with running a trading subsidiary, you'll have internal costs, but you'll also have legal fees, you'll have accountancy fees for doing accounts for that entity and a tax return. So it is definitely worth weighing it up before you sort of jump in to do it. But if you do decide that a trading subsidiary is needed, then, as Chris mentioned earlier, a very common structure is that you have a charity and you have a wholly owned subsidiary. And what would happen is you would move the trading activity into the subsidiary, and then the trading subsidiary would gift aid its profits back up to the charity. As we said before, when the charity receives that income, that is exempt from tax. And because the trading subsidiary now has no profits chargeable to tax, there's no tax to pay in that entity. And the benefit of having a wholly owned subsidiary is that the company has 9 months after the end of the accounting period to make the donation. And that allows the company time to prepare its accounts, sort of draft a corporation tax return and work out what the taxable profits are so it can accurately make a donation. Chris mentioned earlier, sometimes you might not always have a wholly owned subsidiary. So let's say we had a charity owned, say, 50% of it, and there was another company or individuals owned the other 50%, then you don't have the benefit of this 9 months. And you can still make gift aid payments. It just means you have to do them during the year, and it's much harder to predict what the profits will be. Another slight tricky point is often that the trading subsidiary has to have sufficient reserves to make a gift aid payment. So in accounting terms, the gift aid is treated as a distribution. So you will need to have distributable reserves to be able to make the payments. You will also need to look at the interaction between the charity and the subsidiary and consider recharges. So for example, you probably have staff who are employed by the charity. That's the sort of most common thing that we see, but they may also be working for the subsidiary. And if you are, you need to be recharging to the subsidiary an appropriate amount of their time. What HMRC don't like is they don't like a charity subsidizing a trading company. So if you didn't make any recharge for staff, then the charity would be effectively subsidizing that. And that in itself can have adverse tax consequences for the charity. So it's really important to treat these as separate entities. HMRC see them like that, and make sure you're recharging for staff, property, or any services between them. And again, Chris touched on sort of funding a subsidiary. So yeah, it could be put in a share capital. What we tend to see a lot of is we tend to see charities lending money to the trading subsidiary. And that loan that's been made has to be a sort of qualifying investment of the charity. So is that really good use of the charity's money? And HMRC would like to see that that's as sort of commercial as possible. So if you are making a loan, it's really advisable to make sure that it's commercial, it's got repayment terms, there's actually a loan agreement in place, you're charging a commercial rate of interest, and that will really help. Back up that this is a good use of the charity's money. And now Scott's going to touch on some of the VAT specific points on this.
Yes, hello again. As far as VAT's concerned, it is kind of I guess the poor tax is the afterthought from corporation tax, but it's still important and can kind of result in costs that people don't budget for initially. So the main reasons or the main issues associated with VAT and subsidiaries is that just because the charity has a certain VAT liability of activities doesn't mean the subsidiary will be the same. And I've seen within the arts, seen within healthcare, seen within education, the use of a subsidiary, he spits his words out, to try and change the VAT liability of the activities, both to avoid VAT or to remove VAT or to charge VAT. And you know, there can be many reasons why people would want to do that. But for example, 9 times out of 10, if a commercial subsidiary company is providing education, that will be standard rated, liable to VAT, whereas if a charity provides it, it won't. Similarly, if a charity was to have admission charges to a museum or a gallery or a theatre, or charges for care, social care, or healthcare, chances are that would be exempt, whereas with a subsidiary company, chances are it's going to be VATable. When we look at subsidiary companies, we also expect the subsidiary, because it's making VATable supplies, to be able to recover the VAT it incurs. So again, if you're looking at a fairly significant capital spend or lots of investment, often subsidiary companies are considered because they can recover VAT. If you do have a subsidiary company, and we talked about intercompany supplies and intergroup supplies before, it's better to have a VAT group if you can. It does 2 things. It means that you don't have to worry about VAT on intergroup charges. So that means the charity won't incur VAT on charges from the subsidiary, which is a good thing. But the benefit is also that the subsidiary, if it's making VATable supplies, that can taint or improve the recovery of VAT by the charity as well. So it's quite a nice kind of little byproduct of having a subsidiary. And the final point to mention is that there are limited savings, VAT savings available for charities. They won't be available for subsidiaries. So, you know, things like building projects, advertising charges, fuel and power, subsidiaries aren't going to get the same benefits as charities would. I think that's it. Should we move on to the next slide? We're going to cover here that we've kind of talked about putting one in place and what you should do if you think you need one. This is where you have one and you perhaps don't need it or don't want it. I'll kick off, Kirsty, and we'll start with the bottom one first. If you do decide that you want to get rid of or remove a subsidiary company, think about the VAT position. For all the things I've just mentioned already, will have the kind of the opposite effect. You're going to have to think about the activities changing VAT liability, perhaps if they moved into the charity. You're also going to have a look at the charity perhaps losing its VAT recovery. On the plus side, you may get some savings on fuel and power, etc., that you didn't get within the subsidiary company. So you're unpicking all of the VAT issues and benefits I mentioned before. Kirsty?
Great. Yeah, so as we said earlier, the charity and subsidiary structure works really well, but just really over this last year in lockdown, we've seen some of these subsidiaries struggling more than they were. They were probably struggling before, but as a result of COVID, you know, we've got things like theatres that have got a bar in its subsidiary, which has also been closed for the whole time. So it's really at the point when do you decide to sort of close it down? So if the subsidiary is in a position where it's got debts it can't pay, and the charity, what we typically see is the charity's been lending it money and is just continuously, you know, lending more and more money. At what point do you have to say, actually, it's time to stop doing this? And I think in some ways that's a sensible thing sometimes for the charities, rather than just ploughing in more and more cash. So if you are considering shutting one down, it might be that you then scale back the activities that are happening in the charity. So for example, if you did have a bar in the charity, then you might close it altogether, or you might just run the bar through the charity but only open it to the people who were attending the theatre, and therefore you wouldn't have the need for the subsidiary. But you should take advice on this. If it's insolvent, then if you wanted to close it all down, you would have to do a creditors voluntary liquidation. And if it is in a solvent position, a members voluntary liquidation. The charity will have to consider whether it's going to get its money back. If it's lent it, it's probably unlikely, and it probably have to write this off. That will not be taxable in the subsidiary company, but the charity is likely to have lost quite a lot of money, and you might need to look at whether you report that to OSCR. It really depends on the level of the loss. Or not. And then now Leanne is going to talk a bit more about OSCR's concerns.
Yes, so many of the concerns that have been raised so far about HMRC are echoed by OSCR. OSCR absolutely want to see an arm's length transaction. So if you have decided, because of this seminar or because of the facts going on, that you want to set up a trading subsidiary, or if you currently have one, these are just some tips to make sure that OSCR are going to be happy with how you're dealing with it. So we've said arm's length, there's been a lot chatted about that. In terms of the charity, it's important that you consider your conflict policy, because as Chris mentioned, it's likely that there will be an overlap between the charity trustees and the directors. There needs to be a degree of independence there, but you should consider your conflict policy to make sure that that's accounted for. You need to be realistic in terms of quorums and the like. You know, if those directors aren't going to be able to vote, make sure, because they're conflicted, make sure that your quorum and your charity constitution allows for that. And that's the type of thing you can change without having to consult OSCR. So it's very easy to do. But also make sure that you're considering the stage that if a director does have to vote, what would that look like? What would the conflict policy say in terms of that? Should they be part of the discussion or not? And just think that through in practical terms is what will work for your charity. Kirsty mentioned HMRC registration for charities. Now, most of my clients, when they register a charity, think that that's done and dusted automatically. That's not the case. It's a separate process that you need to go through. In my experience, they pretty much always backdate it to the date that they were either incorporated or that the trust was set up, but it is a second point that you need to do. The bugbear with that at the moment is that you have to have a charity bank account before you can register with HMRC, and actually trying to get some charity bank accounts open through the banks isn't always the easiest thing, but just don't lose sight of it. It's something that you should certainly do. So OSCR want to make sure that the charity isn't propping up the subsidiary, anything between the two should be commercial. But we need to put a dab of realism in here. You know, it's all well and good us saying you should have almost entirely separate boards, and you should have commercial agreements between the two. But actually, if you're just setting up, what will that look like? And what do you do if that's not possible? So an example is I act for a landowning charity, and they have a commercial lease to the trading subsidiary of the land, and the land is managed by the trading subsidiary for events and that type of thing. So the commercial lease is, you know, it does what it says in the tin, it's commercial, there's a commercial rent payable, and there's a rent review every 5 years. So we got to the 5-year rent review, and the lease said that it would be decided by a surveyor. So far, so good. The land value in the trustee's opinion hadn't gone up significantly, but when they went to the surveyor to get the valuation, they quoted that it would be approximately £15,000 plus VAT to do the reassessment of the rent. Then you would have had to have 2 sets of solicitors involved in negotiating the rent review and entering into the amended lease. So for the charity, they would be getting a slightly increased rent, but there would be an awful lot of expense to do that. So it didn't seem in anybody's best interest, apart from ours and the surveyors, to go ahead with this. Now, in that case, the charity trustees are going against what the commercial lease says. So we had to be very careful to minute exactly why they were doing that. And in my experience, charity trustees are quite good at minuting what the decision is, but not always at minuting the rationale behind that decision. And that's going to be the important thing if OSCR ever want to question why a decision was entered into. In terms of regulation, OSCR are actually really quite reasonable. You know, hindsight is 2020. We all can see in the cold light of day 6 months later what may or may not have been a good decision. But actually, when you're in and amongst it, it's making sure that you can show that you're putting the charity's interests first and foremost, and that your decision was taken on that basis, taking into account your duties as charity trustees. That's what's going to get you your get out of jail free card if OSCR ever get involved. So be realistic, but minute everything is my advice. So what was the issue? What decision was taken? What mitigation was put in place? So for example, going back to that rent review, we said, okay, this is what we're going to do. We'll just agree between the two parties the rent, we'll save all of that cash, but we will review it again in 3 years' time. So there was a mitigation there that, yes, it might have been the wrong decision. We don't know based on the market, but actually it will be reviewed again in 3 years' time. So it's a quantifiable loss, or quantifiable risk, I should say. And then why, you know, set it in stone. Why is that in the best interest of the charity? And then if anybody ever comes back and asks the questions, you've got the rationale behind it. And that's what OSCR will be looking at. They don't expect you to get it right all of the time, but they expect you to have the right motivation behind the decisions that you're making. So that's all I was going to say on the OSCR concerns side, other than I think that this is something, as Kirsty said, I think charities will have been propping up during the lockdown. So I think it's something that will be coming to the fore, and conflict of interest is always a big thing for OSCR. So please do keep an eye on that. And if you don't have a conflict policy, think about doing it. I'm going to hand back to Scott for questions in a moment. But before I do so, I just wanted to address one of the questions about employment law that came through, just to make sure that's covered off. So massive caveat, I am not an employment lawyer. It is absolutely not my bag. It's very bespoke and based on your charity's circumstances at the time. But as a starter for 10, this is a kind of general recap of the options. So in an ideal world, you decide to set up a trading subsidiary because you've been carrying on a trade, but you think it's going to go over the £80,000. And actually that trade has got certain people who dedicate all of their time to it. So you set up a trading subsidiary, you transfer that operating, and you transfer the staff with it, and they go across under the 2Pay regulations, which means that they get their length of service, their conditions don't change, and the rest. That would be lovely and nicely packaged, but in my experience, people who work for charities do about 15 jobs, I think, on average. So the likelihood of them just doing that one piece of work seems quite unrealistic. So you're then saying, okay, how is this individual going to split their time? So you've really got 3 options here. You can have individual contracts for the member of staff. So, you know, say they do 2 days a week for the charity and 1 day a week for the trading sub. you have 2 separate contracts of employment for that. So they have 2 separate employers. From a legal perspective, that's probably neatest, but it would be a bit of a faff in practice, because how would the holidays be, appropriated? Are they going to have 1 week here, but they'll have to come in to do that job? And realistically, you're going to have 2 payrolls, 2 contracts of employment. And realistically, I wouldn't imagine that they actually do 2 days set a week on one and 1 day on another. They will be doing some emails here, some letters there, and it will be mixed amongst the day. So that's an option, but possibly not ideal. The other option is that they contract a service level agreement between the 2 organisations. So either the employee is employed by the charity, and the charity agreed to provide services to the subsidiary, and then there would be the chargeback agreement, as Kirsty alluded to. Not my area of expertise, but I suspect you need to be careful on scale to make sure that's not going to tip you over the earned income point, because that's not what your primary purpose is. Or you do it the other way around. So the staff is with the trading subsidiary and then does some work for the charity in a service level agreement. And that can either be a benefit in kind, or the charity can pay for that, depending on the process between the 2. The other option, which is quite popular, is to do secondment between the 2. The last 2 options mean that the employee only has 1 employer, there's only 1 payroll, which is a lot neater from that perspective. From a risk perspective, however, I wanted to check that out with the employee. If your employee is seconded to another organisation and something goes wrong in that other organisation, and then they have a claim, the employee could claim against either the secondor. So basically, they could have, I can't get the terminology right, but they could claim against either of the organisations. So it's not getting you out of jail free for risk. The other thing, just on a very general point, is if there are agreements between the 2, please make sure that there's something in writing, because often we see 2 parties agree, everybody knows what they're doing. 5 years down the line, both boards have changed and there's no audit trail of that. So please make sure that if it's a lease, if it's a service level, if it's a secondment, whatever it may be, just get something in writing so everybody knows where the land lies. So that's a very general thing. I don't think it's probably answered all of the questions on employment law, but I don't know any more answers. So I will leave it there and hand back to Scott.
Thank you, Leanne. Just to pick up on a couple of points you made there, if you have charges between the charity and the subsidiary, and you have those sorts of arrangements that Leanne's just mentioned, be careful. There'll be tax issues, but there are VAT issues. And if you have contracts of employment, say with the subsidiary, and charges going back up to the charity, and you do not have a VAT group in place, then chances are you're going to incur VAT, that will become an irrecoverable cost to the charity. So back to what I was saying before, if you're setting it up, certainly from my side of the fence, VAT grouping is probably a good thing to look at. Just also, Leanne, you mentioned the effect of COVID. So what we're seeing a lot of just now is a change in activities. It might just be things are being done online rather than being face to face, but that can have an implication on classification of activity and VAT and tax classification of what they're doing, because don't automatically think because you've done something in person, if you translate that to doing it online, the tax rules are the same. They're not always the same. And also, we've seen a lot of charities say, right, hold on, COVID's made us stop and think about what we're doing. There's lots of things that we don't need to do anymore, lots of things that we're not going to bother about, but there's a lot more things that we're thinking that we want to do. And we're seeing a lot more kind of collaborations and joint ventures between charities, NHS bodies, public sector bodies, commercial bodies. So again, if you're getting into that, that might be a reason to think about a subsidiary company and think about the legal position and think about the tax position. So just before we'll go into questions now, but just to summarize, if you don't have a subsidiary, I guess the question is, do you want one? Do you still need one after all that? But do you want one? And if you do, then think about the tax, the risks, the tax issues, the risk issues, legal issues, and practical issues. And the as I said before, the outcome, the best outcome for you will be a combination of all of those, but it will be unique to your organization. And it's exactly the same. If you've already got a subsidiary, take stock of what you have at the moment and think about the tax, the risk, the legal, the practical points, because it's fine saying, you know, you might want to get rid of it you don't need it from a tax point of view, but you might be there for risk or for legal purposes or for some other purpose. So think about everything in the round. And again, as I say, the optimum outcome for your organization will be unique to you. I think I speak for everyone. We're more than happy to talk. We're more than happy to talk individually, and we're more than happy to talk collectively if that's needed as well. Just get in touch either via SCVO or directly, and I'm sure, you know, I speak for Leanne and Chris as well, that we're more than happy to help.
Absolutely.
And at that point, Tracey, do you want to get those quick fire questions in?
Yes, I've got a couple of questions here. One from Claudia Richardson. She's saying, does it make any difference when deciding if it would be better to set up a subsidiary, whether the trading is charitable trading or trading that doesn't come in with the charitable objects? So I don't know, Leanne, would you be able to answer that one? Or because I think there's obviously tax implications, but it's all about charitable objects as well, what you're doing.
From the charitable side, if it's not something you should be doing or can do under your constitution, then you either need to put it in a sub or consider extending your constitution. And the decision as to whether to do that or not will probably be led by tax, I would suggest, whether that's a good idea to do. So I'll hand over to Kirsty at this point.
Yeah. So hopefully we covered sort of this point as we went through the slides earlier. But yeah, if you've got charitable trading, so trading that meets your charitable objectives, you know, like we said earlier, like you've got a theatre which is selling tickets, that's part of your objectives. Then that is exempt from tax, and there isn't necessarily the need to move it into a subsidiary. But if you start doing some other trading which is out with your charitable objectives, then that will be taxable, and it's at that point you need to decide whether you need a subsidiary or not.
Can I just jump in? One of the things I saw recently was it was a care charity, and it was looking to continue doing what it was doing, but it was doing it in a much wider geographic spread. So within its charity objectives, it talked about providing the care service, but just in a certain geographic area. And by going out with that area, which was in its objectives, it was kind of then going into a trading activity. So I think the choice it had, it was either think about subsidiary company or think about another charity, set up another organization, or change the objectives. I'm not, Leanne, Chris, I'm not entirely sure how easy it is to change objectives, but those were the options that charity looked at.
I mean, in terms of changing objectives, any changes at all to the wording of your objects would need to be consented to by OSCR first, but you're knocking at a relatively open door there. You know, OSCR would much rather see you change your articles to make sure everything you're doing is within them than be difficult about it or cause problems with trading subs or anything like that. So if it is something that you're considering doing, you're probably knocking at an open door with OSCR. Just bear in mind that any funding that you have that is specific to, for example, that geographic location couldn't then be used out with it. You'd have to think about restricted funds for that. But yeah, you're knocking at an open door with OSCR.
It's good.
Great, thank you. Okay, another question from Dave Close. If our trading is likely to be under the £80,000 trading limit for the first year or two of trading, is there any downside to beginning trading without a subsidiary and deferring the decision whether or not to create a subsidiary? But so I don't know who on the panel wants to answer that.
I can take that if you want. So yeah, so it's fine to defer it as long as your total income of the charity is over the 320,000. So I don't know, actually we could even skip back on the slides to the there's a table, but actually even if you Google small scale trading, then you can see on this table. So if your total income is actually under 32,000, you've got a maximum of 8,000 that you could have. And then if it's between the 32,000 and 320,000, it would only be 25%. So a lot of the charities we deal with do have income over 320, so that's why we talk about always the 80,000 limit. So it's just to be careful about that. But I'm happy to have a call separately with you about this if you want to look at the specifics of it.
Great.
And on the VAT side, if you go above the 85,000, there's VATable activities, you will need to register the subsidiary kind of compulsorily for VAT. And just watch out if you've got activities that are VATable in the charity, and then you add on another 80,000, subsidiary activities, you might find that that you've gone over the VAT registration limit and need to register the charity. It's fine if you want to register. If you don't want to register, maybe subsidiary being set up at an earlier stage might be what you want to do. So yeah, there's a couple of different avenues to think about that.
Great, thank you. Question from Margaret. Interested in the issues that might be raised by establishing a charitable subsidiary where the parent organisation is an RSL, which I presume is registered social landlord, and a charity. So I don't know, Margaret, whether you wanted to add to anything in the chat, or can anyone take that? Was there anything specific to RSLs?
I've seen with RSLs, charitable RSLs, them setting up subsidiary companies to operate factoring services or construction services, and that from my side works really, really well. Again, back to the point I made before, you want to have a VAT group in place, because if you do that, the VATable activities that go through the subsidiary, being construction of buildings or being maintenance and repair of buildings, they all add to the overall benefit of VAT recovery for the charity as well. So general overheads incurred by the charity then benefit from recovery that's been orchestrated by the subsidiary. And also you ignore intercompany charges, and there usually are intercompany charges with the subsidiary and an RSL. So I've seen it work in practice, and I've seen certainly OSCR haven't had any issues with those, and similarly the funding organisations for RSLs haven't had any issue with it at all. And just finally, and I'll be quiet after this, if you're building new properties, so new housing, for example, if you use a subsidiary company to construct and you use design and build contracts, you can often remove the cost of VAT from professional fees. Ordinarily, there are VAT and professional fees, and that's not recoverable by an RSL. But by using design and build and subsidiary companies, you can remove that, and that can be quite a good saving. So again, happy to talk that in a bit more specific detail if anybody wants to phone me.
Right, thank you. And Nigel's asking, where a charity with £100,000 turnover provides syndrome awareness and skills training, is this an exempt activity if it fits into the charity's constitution, even if it's charged for and registered for CPD? Because their total turnover is 100,000, but the money they're making from the training is much less. I don't know, do we? So anyone wants to answer that one?
Shall I'll comment a bit, and then we might pass on to some of the legal side. So I think it's difficult to know without probably a bit more information, but the fact that you're charging doesn't necessarily mean it's necessarily taxable if it fits into your objectives. But if you're charging for training, I think my question would be, is there any sort of private benefit to the training, or is it actually open to everyone? That's how I would sort of look at it in terms of whether we were deciding if it was part of your primary purpose objectives for tax. So if it was open to everyone and you're charging for it, then it might be fine. But if you're doing sort of private training courses for, let's say Azets wanted a private training course and we came, then that's not open to everyone and there's no public benefit. Then that could be potentially taxable. I don't know on the legal side if you have a more comment on that.
Yeah, I suppose it's just to make sure. Sometimes that we see a bit of mission wander or mission creep with this type of thing, where you very much go back to your constitution and say exactly what it says, because sometimes people view helping a particular disability or something, or group with disability or something like that, as raising awareness, which can help. But where does that stop? Is training individuals actually helping that group? Now, if your constitution says that you're going to raise awareness and train people, and that's great, but just be careful that that is actually covered by your constitution if you're trying to claim primary purpose training, and just go back. That's just a general tip for all. We have seen, or certainly I've seen a few lately. I think COVID has given people the chance to sit down and take stock, and a lot of charities are doing governance review, and it's been quite interesting to see that sometimes what is in their constitution isn't necessarily what they think is in their constitution. So please don't look at vision statements and mission statements and all the rest of it. Go back and look at the boring legal document. It's probably just a paragraph in there. Yes, it's going to be a bit dry, but that is what you need to look at. The amount of charities that I see who look at the vision and the mission, which is kind of grown arms, you know, it's Chinese whispers that started off based on the constitution, then that's been changed over time. And all of a sudden you have a new board that maybe think they know what the charitable purposes are, but it might not be exactly what it was before. And again, if that is the case and you think actually we're starting to push the edges here, consider whether A, you still want to do that, and if you do, then just change your constitution and apply to OSCR to do it.
Great. Thank you. Well, there aren't any more questions in the Q&A, so it just left to me to thank you all for your contributions. And
Gee, I think
everyone.
there's another one. I think there's another one just arrived.
Oh, okay, right. We'll quickly do that one then. So we've only got a few minutes left, but when would income be considered trading income? And what is the definition of trading income? They provide services as a charity which are funded by those who we provide them to, schools below cost. Is this trading income? Because the rest of the costs are from grants. I don't know. Who's going to answer that one?
Again, we probably need a little bit more information, but if it's something you're doing in return for a service, then it's likely to be trading income. So things that are not trading income is things that we had on our very first slide, like bank interest and grants. That's not trading. Whereas if you are providing some kind of service in return for payment, then that's trading. And then it's whether you look at is it primary purpose trading or is it not? But if the person the name's gone, if they want to have a sort of direct chat about it, I'm happy to talk about it more.
Kirsty, can I ask, for example, if it was educational, so let's take the scenario that you've got, I don't know, you've got a museum or a gallery or some sort of care body, and it's going to then provide some sort of course or some sort of training to some, as I said in the note, maybe schools. I would have, in my mind, kind of said initially it was seen as being educational. And if they had within their constitution and their objectives, educating people on the art or the social kind of function, then that in my mind would have kind of made it a bit more charitable than trading. Is that a fairly naive approach, or is that okay?
No, I suppose it's once you've decided if it's trading, is it charitable trading or not? So in that situation, education could be trading, but it could be charitable trading. So like if you had a private school which is charging fees, that you're doing something in return for a payment, but it's part of their objectives, so it would be charitable trading.
The key then is to go back, as Leanne was saying, go back to your objectives and see what it says in the objectives, and if it's there, you might be okay, but if it's not, you need to speak to someone.
Yeah. Okay, that's great. Thank you. It's been really useful, and as our panelists have said, if you've got any specific questions, do get in touch with the SCVO Pro Bono Service or directly. Thanks for your attendance, and thanks to our presenters for their input. And it's just left to me to say goodbye, and thanks again. Bye-bye.
Bye.